Welcome to day 9 of our 12 days of Ec 10. Today we're going to focus more on trade, building on what we learned yesterday, doing what I call advanced topics in trade. So there's two ways we often combine trade with other topics in the course and try to synthesize them and make you kind of draw everything together and really show us that you learned a lot from the course. And one topic we often like to combine with trade is a monopoly. So first let's review, before we add in trade, let's review what happens with a monopoly when we don't have trade. We'll have a marginal cost curve, shown here. We'll have some demand curve, which tells you the price that the monopoly sells at, which is why I like to label it P. You'll often also see it labeled D for demand, which is kind of misleading. And then we have some marginal revenue curve. The monopoly is a price maker, right? It gets to decide its price. And we know that price makers have, hopefully you remember this, price makers have MR less than P. And this was discussed in detail in our firm behavior video. I think that was 2 days ago, day 7. So if this part about price taking, price making is not clicking immediately, then please go and review that video before moving on. Alright, and then we know it maximizes profit, so it's going to pick a point where MR equals MC, so that's this point here. This is how much it produces, Q star, and then it charges a price according to the price curve, or the demand curve. So this is its P. And this is what would happen if the monopoly had just complete control of the market. There's no other firms, because it's a monopoly. There's no other firms in other countries, because there's no trade. So even if there were, they wouldn't matter. So it's a price maker. It makes a price by choosing the profit maximizing quantity. Now imagine we open up to trade. So there's a fixed world price given by this line. It is the same marginal cost curve, same demand curve domestically, but it doesn't really matter what domestic demand is now because the firm can sell overseas. And more importantly, the firm also has to take into account that local consumers can buy from overseas. They can import stuff at a price of PW. So if this monopoly sets a price, let's say that it sets a price way up here, because that's profit maximizing, just imagine that were the case. Would it sell any units? No, right? Because all the consumers could get this low price PW just by importing. So the monopolist couldn't possibly be maximizing profit with such a high price. And if we think about this a little bit more, we realize this situation is totally different from without trade. The monopolist is just a price taker. It really has no ability to charge above this price P world. It just has to take that price as given. Despite the fact that it's a monopoly and is very powerful domestically, on a world scale it really is not very powerful. It's just one of many, many, many firms, to the point where it's really misleading to call it a monopoly because it's competing with so many other firms, and thus it has no pricing power. So now we can see that since it's a price taker selling at PW, P equals MR, like we see with all price takers, and in particular that price is the world price. So this curve here is MR. That's really the key realization, the key insight to understanding how monopolies operate in a world trade situation. Once we see that this is our marginal revenue curve, everything operates just like before. We set our price, we pick our quantity so that MR equals MC, so we get this quantity here. And then our price is given to us, it's given by this PW curve. So this, if it's not obvious, this PW is our price. And that's what all monopolies will do when they're open to trade. That's pretty much all you really need to know to solve these problems. You'll see problems where we ask you to derive, is the profit higher or lower for this monopoly? You'll have to do some calculating. You'll see us ask you about, is welfare higher or lower because of opening to trade? As a pretty good guess, it will be higher when you open to trade. The only exception would be if it causes some really negative externality to get out of hand. But as long as you parse it into little sub-pieces, which you'll hear about in a future video, I've actually already posted it, so you may have watched it. As long as you use this insight and parse the problem down into little, simple sub-problems, none of these monopoly and trade problems should be very difficult for you. So now we get our second application, where we combine externalities with trade. So we'll get a diagram that will look like this, or maybe even a little bit more complicated. We'll have, as usual, our demand curve and our supply curve. But now with externalities, we're also going to see social benefit, which is often going to be different from demand if there's a consumption externality. And then we might also see a marginal social cost, up here or down here. But in this case, there's no production externality, so we won't. And the thing that's tricky about externalities with trade is that usually we just say, consumers buy some quantity Q, producers produce some quantity Q, and then you can determine producer and consumer surplus. But when we do trade, there's two Qs. There's QD, and then there's QS. And that doesn't make consumer and producer surplus that much more difficult. We know the relevant Q for the consumer is going to be QD. That's how much the consumer buys, so that's what we're using when we do consumer surplus. We know QS is for producers and producer surplus. But what about with externalities? For instance, on this diagram, what is the QD? Hopefully you see it immediately. It's right here where demand intersects world price, and then supply is going to be right here where supply intersects the world price. When we calculate our externality cost or benefit, here it's a benefit, right, because we can see benefits exceed costs, which Q should we be using? And what I want you to do is just kind of try to use common sense. This is a consumption externality, so it's associated with consuming the good. So is it going to be associated with the quantity demanded and then consumed, or the quantity supplied and produced? And the terminology alone pretty much gives it away. It's QD. So in this case, when there's a consumption externality, whether it's positive or negative, they will be associated with QD. And then the other possible case, where you have a P plus or P minus, they'll be associated with QS. So here, if I wanted to calculate the marginal externality benefits, it would be this Q, and then this is the height of our benefits, and then I'd shade that all the way back to 0. So it would just be this. It would not be this extra space that I'll put in like red. We would not have all of this red stuff because we didn't consume all of these units, so we're not getting any externality benefits or costs from consumption of that. They're only associated with consumption, as the diagram makes perfectly clear. So red is not part of EB. So to summarize, just to drill that home, if it's a production externality, only calculate EB based on what is produced on QS. If it's a consumption externality, use QD. Only the goods that are consumed could provide you with a externality cost or benefit. So in summary, our two main lessons, our syntheses that you need to know to understand and do all the trade problems are: monopolies cannot change the world price. They're just not that powerful. They are price takers, so they take the world price as given, and that's their marginal revenue. That's how you deal with monopolies and trade synthesized. And then if you're doing externalities and trade synthesized, just remember consumption externalities only depend on the amount consumed, QD. Production externalities only depend on the amount produced, QS. That should make it easy to calculate externality benefits. And then producer, consumer surplus, and government revenue are always easy. Then you have your nice table, and the problems are pretty straightforward. Thanks for watching. Test is just a few days away now, so hopefully you're starting to feel pretty confident. If not, now would be the time to start. We've got lots of good short answer questions, old exams available to you, just practice problems. I think on the course website there's 5 or 6 practice problems that mostly focus on chapter 22. Good luck with your studying, and I will see you tomorrow in our next video.